Most people have a bank account. Most people use a bank every day of their adult lives. They deposit money, withdraw money, take loans, pay bills, receive wages. The bank is as ordinary as a post office, as unremarkable as a street corner. It is simply part of the furniture of modern life, present and functional, and largely unexamined. And yet if you ask most people what a bank actually is, what it actually does, how it actually works underneath the surface of the ordinary transactions, the honest answer is that most people do not know. Not because they are unintelligent, because no one told them. Because the actual functioning of banks is one of those things that is hiding in plain sight, visible to anyone who looks directly at it, but surrounded by such a thick atmosphere of normalcy that the looking rarely happens. So let us look directly. The story most people carry about banks goes something like this. People deposit their money in the bank for safekeeping. The bank holds that money and lends some of it out to borrowers, charging interest on the loans. The interest is how the bank makes money. The deposits are the raw material, the loans are the product, and the bank is the intermediary connecting savers who have money they do not currently need with borrowers who need money they do not currently have. This story is not entirely wrong, but it is missing something so significant that understanding what is missing changes your entire picture of how the economy works. Banks do not lend out deposited money. Banks create money when they make loans. Read that again, because it contradicts something most people have assumed for their entire lives. When a bank approves a loan and deposits the loan amount into your account, that money did not come from someone else's savings. It did not come from reserves sitting in a vault. It came from nowhere. It was created by the act of making the loan. The bank typed a number into your account and that number became money. Real money that you can spend, that other people will accept, that will move through the economy as though it had always existed. This is not a theory or a fringe claim. It is how banking works, and it has been confirmed explicitly by central banks themselves. The Bank of England published a paper in 2014 stating this clearly. Money in the modern economy is created by commercial banks making loans. Most of the money in circulation at any given time was created this way, not printed by governments, not minted as coins, created as a number in a database when a bank decided to extend credit. Let that settle for a moment, because the implications reach into everything. It means that the supply of money in the economy is not primarily controlled by governments or central banks in any direct sense. It is controlled by the lending decisions of commercial banks. When banks lend freely, money expands. When banks pull back and lend less, money contracts. The volume of economic activity, the availability of credit, the ease or difficulty of doing business, of buying a home, of starting a company, all of this is shaped by the lending behavior of private institutions whose primary obligation is not to the public, but to their shareholders. This is a remarkable arrangement, and almost no one who lives inside it has been told that this is what it is. Now ask how it came to be this way. Because it did not start this way. It developed through a history that is worth knowing. The earliest banks were goldsmiths. People brought them gold for safekeeping and received receipts in return. The receipts began to circulate as a convenient substitute for carrying gold. Then the goldsmiths noticed something. The gold almost never all left at once. People deposited and withdrew, but the total stock in the vault remained relatively stable. So the goldsmiths began issuing more receipts than they had gold to back. They lent out receipts representing gold that did not exist. And they charged interest on those loans. This is the origin of fractional reserve banking. The institution holds a fraction of what it promises and lends out the rest. In the goldsmith's case, the fraction was the actual gold. In the modern bank's case, the fraction is reserves held at the central bank. The principle is the same. More is promised than is held. The difference between what is promised and what is held is lent out and generates returns. This works as long as everyone does not ask for their money back at the same time. When they do, it is called a bank run, and bank runs reveal what the bank actually is. Not a vault, not a safekeeping facility, a confidence institution, a promise that functions as long as it is believed and collapses the moment it is not. The entire global banking system is, in this precise sense, a confidence system. It is stable not because it is backed by equivalent real assets, but because enough people believe it is stable that they do not test it simultaneously. The moment collective confidence breaks, as it has broken repeatedly throughout history, the system itself is in danger. This is why governments guarantee deposits. This is why central banks act as lenders of last resort. This is why the 2008 financial crisis required governments to inject trillions of dollars into catastrophically bad loans. Because if those banks had been allowed to fail, the confidence that the entire system runs on would have shattered, and the consequences would have been not a recession but something resembling a complete breakdown of the monetary economy. The banks were saved not because their owners deserved to be saved, but because the infrastructure of daily life had become so dependent on the banking system functioning that its failure was unacceptable. The banks had become, in the language used at the time, too big to fail, which is another way of saying that private institutions making decisions purely on the basis of profit had been allowed to become so central to public life that the public had no choice but to guarantee their survival regardless of how recklessly they had behaved. This is the arrangement. Private profit when things go well, public bailout when they do not. The gains flow to shareholders and executives. The losses flow to taxpayers. The asymmetry is structural and it is persistent. Now go back to the money creation and follow where it leads. Because if banks create money by making loans, then the direction in which money flows, into which parts of the economy new money is created, depends on which loans banks decide to make. And banks make loans based on expected returns and assessed risk. They lend to those who are most likely to repay with interest, which means they lend to those who already have assets to offer as collateral, who already have income to service debt, who already have the track record that makes them appear creditworthy. Money is created preferentially for those who already have. The person who needs credit most, who has no assets, no collateral, no track record, that person is precisely the person least likely to receive it. The person who needs it least, who has property and income and established relationships with financial institutions, that person is most likely to receive it, and on better terms, at lower interest rates with more favorable conditions. The banking system, through its ordinary functioning, its rational profit-seeking behavior, amplifies the existing distribution. It does not create money neutrally and distribute it according to need. It creates money directionally, toward those already advantaged, and in doing so widens the gap that already exists. This connects directly to what we saw when looking at poverty. The structural mechanisms reinforce each other. Ownership generates returns. Returns generate more ownership. Banking creates money preferentially for those with existing assets. More money flows to them. They acquire more assets. The cycle tightens. Now look at interest rates, because this is where the central bank enters the picture and where monetary policy, a phrase most people have heard and few have examined, becomes concrete. When the central bank raises or lowers interest rates, it is setting the price at which commercial banks can borrow from it. That price flows through the entire system. When rates are low, borrowing is cheap, banks lend freely, money expands, economic activity accelerates. When rates are high, borrowing is expensive, lending contracts, money tightens, economic activity slows. The central bank uses this mechanism to manage inflation and employment. When inflation rises, rates go up, money tightens, spending slows, prices stabilize. When unemployment rises, rates come down, money loosens, spending increases, employment grows. It is a blunt instrument operating on the whole economy but felt differently at different income levels. When interest rates rise to fight inflation, it is typically people with variable rate mortgages, with small business loans, with debt of any kind, who feel it most immediately and most painfully. These are not primarily the wealthy. The wealthy hold assets whose value may adjust, but whose essential security is not threatened by a shift in borrowing costs. The person with a mortgage they can barely afford, the small business owner whose credit line just became more expensive, the renter whose landlord now passes on higher costs, they feel the bluntness of the instrument most directly. The management of money is not neutral. Every decision about interest rates, about bank regulation, about what institutions are saved and which are allowed to fail, distributes consequences unevenly across the population. Those distributions follow the same lines they always follow. The structure is consistent. So what is a bank? It is an institution licensed by the state to create money. That is the core of what it is. Everything else, the branches, the apps, the savings accounts, the mortgages, the investment products, is built on top of that core function. The bank creates money as debt, The borrower receives money that did not exist. The bank receives a stream of interest payments in return. The money creation is private. The consequences of its failure are public. This is not a secret. It is documented, acknowledged, and visible. But it sits beneath the surface of ordinary financial life in a way that most people never encounter, because encountering it raises questions that are uncomfortable for the current arrangement. Questions about why the power to create money, which is the power to direct economic activity, to shape what gets built and what does not, whose dreams get funded and whose do not, sits with private institutions whose obligation is to their own profit. These are not questions with simple answers. The banking system, for all its structural inequities, also enables the scale of economic coordination that keeps 8 billion people alive and connected. Dismantling it without understanding it fully would be catastrophic. The point is not to destroy it. The point is to see it. Because the person who understands what a bank actually is stands in a different relationship to their mortgage, to their savings, to monetary policy, to the news that the central bank has raised rates again. They are not helpless in the face of forces they cannot name. They can see the mechanism. And seeing the mechanism, however it does not immediately change it, is the beginning of the only kind of freedom that is real. Understanding what is actually happening, that is always the beginning.